trends. So will Lulu's NFL deal help lift shares as it is today beyond today? Our next guest is calling it a Hail Mary. Joining us is Jefferies research analyst Randy Konik. He's currently at an underperform rating on Lulu. And Randy, you've been negative on this name for a while. It wasn't just this announcement today. You sort of feel like Lulu's lost its cool. It's lost its way, right?
Yeah, thanks, Courtney, for having me on. They've lost their core is really the issue
there you go.
here. So if you think about the core customer has moved on. That wealthy woman has gone to Alo and Viore. That's a big problem. So as the company started to see themselves losing the core customer, what did they do? They tried to court non-core customers, teenagers, tweens, with a belt bag. That's a problem because if you lose the core, the one that's spending the most money per year, and they're going elsewhere, you kind of you start to go down a slippery slope of losing market share, and revenues go down.
I mean, obviously, we talk about fashion all the time being fickle. I mean, how often do you have a company that can sort of maintain that #1 position in the market, even if they were the first one to innovate in that space? I mean, doesn't it just happen eventually over time?
There's a reason why there's thousands and thousands of apparel companies around the world. Why? It's a very easy product to make. It's lightweight, not a lot of sizes, and has high initial margins. That's great until it's not. And what's not is there's a very competitive factor here. Think about Under Armour. Under Armour was Lululemon from 2005 to 2015. It grew dramatically from $300 million of revenue to a $5 billion business on the income statement, a $10 billion brand if you adjust for retail prices. That business of Under Armour got taken away, that brand strength, by Lululemon itself from 2015 to 2025. So, you know, we see these cycles where if you're a great company, maybe a decade of dominance is where you sit, and that's where Lululemon was for the last 10 years. But it's hard to last forever, and it hasn't for Lulu.
So is there anything they can do to get back there? I mean, this NFL deal and Mirror, I mean, in the grand scheme of things, not huge bets on the business, right? I mean, is there anything that can be done?
Well, the problem is what they're trying to do is throw gum against the wall, try to do a partnership with the NFL. As you said, the Mirror before, they just posted or did a partnership with American Express for the Platinum card to give basically free money to consumers, $75 for a card holder per quarter. That's ridiculous. So what the company needs to do is actually just take a step back. And we think to take a step back, you're going to have an earnings implosion that actually happen next year. So the street's mismodeling this company with flat earnings for 2026 and sales growth of 5% for 2026 as well. We actually think earnings will go down to near $9 next year, which is a huge collapse. And we actually think revenues will be down 5%. And the problem is this company needs to have a hard reset because they're losing more and more market share as they go away from the core with their product assortment. They need to stop doing that.
So what is Alo, Viore? Varley recently I saw being sold in the Dick's Sporting Goods House of Sport. I mean, what are they grabbing at that Lululemon is missing? Because the merchandise to me looks fairly similar on first blush.
You know what they have is they've kept their identity the same. If you walk into a Viore store or an Alo store, it has a feel, right? And that feel or that connection hasn't changed over the years. If you look into you go into a Lululemon store today selling sweaters, Little House on the Prairie skirts down to your ankles. I don't know what that is, but you know that's something you didn't see a decade ago from the company. You saw leggings and sports bras, right? That's the problem here. Is the company's going away from what they did best, and it's not going to get better.